Good morning, good evening, good afternoon, and welcome to the Booms and Bust Show. My name is Jonathan Davis, and it is Monday, the 5th of February, 2018. This is the weekly Booms and Bust Show, where we talk about free market capitalism, libertarianism, free speech, and we take the Michael out of all the other isms, fascism, socialism, communism, etc., because they're all on the same spectrum, as we see time and time again. The socialists say we really support Chavez and Maduro, and now all of a sudden when Venezuela is literally going to pot, literally is perhaps not the right word, you don't hear a peep from the socialists because they are just total, utter liars. All they care about is power. They don't care about helping the people, they just care about the elite. Talking of which, you'll recall in the last week or two, I talked at some length about a 4-page memo about the intelligence services, particularly the FBI and the Obama administration and the Federal Intelligence Service agencies. Well, we have now this dossier. It's now been unclassified by Donald Trump. And what do we see? A widely anticipated House Intelligence Committee memo on alleged FISA, which is Federal Intelligence Services Agencies, abuses by federal authorities was just released to the public. And you can, it's the Nunes memo, N-U-N-E-S. He's the chairman of the Federal Intelligence Services Committee. You can go on Google and read this 4-page document. And what it says here is FBI takes, quote, salacious and unverified, unquote, dossier to secret court to get secret warrant to spy on a fellow American. And the FBI doesn't tell the court that the Democratic National Committee and the Clinton campaign paid for that dossier. And they did that 4 times. Well, tough titty, the dossier has now been unclassified and it's now out in the open. This is what the Wall Street Journal has to say about it. The FBI is a tool of anti-Trump political actors. This is unacceptable in a democracy and ought to alarm anyone who wants the FBI to be a non-partisan enforcer of the law. The FBI wasn't straight with Congress as it hid most of these facts from investigators. Senator Mark Warner, Democrat, of course, he said this unprecedented public disclosure of classified material during an ongoing criminal investigation, the one about Trump and Russia, which of course comes up with nothing, is dangerous to our national security. This is what they said about this dossier. The senator cried wolf. Everyone can now see for themselves that the classification labels applied to that memo were an abuse and that in no way threatens the security and of the population of the United States. This is what these people do. Moving on to the Las Vegas shooting, the biggest shooting, I believe, in American history. A judge unsealed search warrant records. They now have a second person of interest in the Las Vegas shooting. He's been identified as Douglas Haig. Now, you remember some weeks ago, I wanted you to remember that in the most videoed city on the planet, it's amazing that no one saw anything and there is no public video footage. Haig's LinkedIn persona shows that he has a Department of Defense top secret clearance. He has worked for top weapons manufacturers, and he specializes in military ammunition. Don't tell me that Las Vegas was a private affair. It's that frightening, folks. Today, in 1637, the tulip bubble burst. You know, the one in the Netherlands. And, of course, it was the first financial bubble scam in history. We'll get on to Bitcoin later in the show. In This Week in History, 53 years ago, was the state funeral of Winston Churchill. We'll never forget that he led our great nation to victory alongside the rest of the Allies. But without Churchill and the British Army, Navy and Air Force, we would now all be Germans. May he rest in peace. The socialists are going crazy in Canada because they've just written their national anthem to be gender neutral. Justin Trudeau, please go back and be a school teacher. Now, I heard over the weekend that a not particularly large final salary pension scheme was closing its books, and it was going to stop taking on new members, and it was going to, in effect, privatize itself. What that means is it's going into discussion with insurance companies in order to give an insurance company all the money that it's got in the pot, and then the insurance company will pay out the benefits to existing retirees and to future retirees. Because quite simply, they've realized that they can no longer do it. They've run out of options. If they have a major problem in the future, they will have no way of getting out of the problem. They got themselves into a massive fix several years ago. They got into a multi-million-pound deficit, and the company had to sell its London HQ a couple of years ago to make vast amounts of profit and pay a vast amount of money into the pension scheme. So in other words, the company itself could not benefit from the wealth tied up in that property. It decided meet its obligations, and it literally had to pay millions of pounds into the pension scheme. Now, the pension's okay now, but as I say, if it gets into difficulty again, then the company's toast, and obviously they can't risk that. So they're privatising the scheme. The point I'm making is that you can see on yahoo.com, there's a news report, 2 out of 3 UK pension schemes are in deficit to the tune of over £200 billion. 3,700 pension schemes are in deficit. You saw Carillion with between £0.5 and £1 billion of deficit. Carillion went bust. That pension scheme has now been taken over by the taxpayer. The poor downtrodden taxpayer, yet again, has to foot the bill. There are 3,700 other pension schemes which, if we have another recession, if we have a stock market crash, a corporate bond market crash, they will be in such deficit there is no way the employers will get themselves out of a fix next time. Or can you imagine commercial property flooding the market at the same time to get all these pension schemes out of a fix, you know what that'll do to commercial property. It's pretty frightening. And this is clearly, the pension scheme thing is clearly a ticking time bomb. As you know, I'm not calling for a recession. I'm not calling for a stock market crash. On the contrary, but there will be one at some point. Now, I see that the global bank, HSBC, has been found out again aiding and abetting criminality. Let me take you back to Mexican drug lords, where HSBC actually laundered money for those arch criminals. They did it again in Switzerland a few years later, and they've been doing it, no doubt, again and again, but they've been found out again. When the US bank HSBC was doing this for the Mexican drug lords, the head of the US Audit and Risk Committee was Rona Fairhead, who got away scot-free. You'd think that she'd be the one whose head was chopped off metaphorically, wouldn't you? The head of Audit and Risk? No. When she left the HSBC, she became chairman of the BBC. She's now a baroness, and she is in the Tory government. She's an international trade minister. These are the people who rule us, listener. And this is the kind of thing that people need to get to know about. I want to thank, at the last count, the 26 who retweeted last week's show. That is a record number of retweets. Thank you so much. And more listeners, downloaders are retweeting the show. And that helps me to continue doing the show. You know, if anyone had said to me a year ago when I started the Booms and Bust Show project that it would basically be a day out of my working week to do an hour-long show, I might have thought twice about doing it. Now, don't get me wrong. I say every single week I get an absolute blast from doing the Booms and Bust Show. And I know from feedback from you guys that you're enjoying it, and that's fantastic. But I'm only human. I need a positive response in order to keep doing the Booms and Bust Show. If you indeed get something from this and you want to continue hearing what I'm saying about politics, about free markets, about economics, about investing, then you need to help me. And all I ask of you is two things. If you haven't yet gone on to iTunes, then just click on the iTunes icon, which is there in the Twitter feed. I'll go through Twitter in a minute. Just click there and rate the show out of 5 stars. That you do once, you don't have to do it again. The second thing I ask of you is that you're on Twitter anyway to see the charts and the photos that I input alongside the tweet of this particular show. So if you're on there already, it takes you literally half a second to click retweet. So we've got up to 26 retweets. That is a record for the show. Thank you so much. If that continues, then by the summer we might be up to 50 retweets a show, and that would be great, because that's the way more and more people are going to hear about this. And if you want to continue listening to this show in the long term, then I need from you retweet the show every week. It's a simple deal. I think it's a reasonable deal as well. Talking about the BBC, Lord Norman Tebbit tells us that analysis shows that out of 4,275 guests on BBC Radio 4 talking about the EU, 132 of them, only 3.2%, were Brexiters. 96.8% of pundits on Radio 4 were Remainers. If that isn't anti-democracy, because I remind the BBC, we had the vote, we are leaving the EU, and I am delighted to hear 10 Downing Street's announcement to the media today, just today, that Theresa May confirms that we will not be in the single market when we leave the EU. Now, that suggests that we are actually going to Brexit. Of course, we've still got the 2-year transition. So what does it mean? Does it mean we will be out of the single market at the end of March 2019, which is only about a year ago to go now? Or does it mean we will be out of the customs union, the single market, by 2021? I don't know. What I do know is the longer it continues, the more chance we will stay in the EU, because they could get rid of May. Having said that, I was driving along and I heard that Boris Johnson, Michael Gove and Jacob Rees-Mogg are leading a faction in the Tory party that if May doesn't do Brexit, then they will oust her. And get this, Jacob Rees-Mogg, probably the most free market in the Tory party, would become the Chancellor. If that happened, even I would vote for the Conservatives. Still on the BBC, senior Labour MP, Shadow Treasury Minister Clive Lewis has admitted pushing his political bias in his work when he was a senior BBC journalist. Yeah, as if we didn't know about him and everyone else. You know, I'm talking about these people who rule us. Julian Assange, the founder and leader of WikiLeaks, surely one of the greatest organisations on the planet. UK prosecutors have finally admitted destroying key emails in the Julian Assange case. They've now dropped the charges. The US case continues, and if you want to read more about that, go on to iamwikileaks.org. 2017 insolvency annual statistics for individuals for England and Wales. Total insolvencies up 9.4% year on year. Individual voluntary arrangements up 20%. And IVAs have now reached their highest annual total. Total individual insolvencies are now about 100,000 in 2017. Corporates, company insolvencies up 4%. The creditors' voluntary liquidation, a bit like an IVA, up 8%. Number of companies gone into liquidation last year, it's 17,250,000. 17,250,000 companies went bust last year. And you know what every single one of those companies had in common? They all had a bloomin' accountant. They're even more useless than economists. I see consumer confidence. I'll put the charts up on the Twitter feed. Go on to Boom's Busts show. If you're not already a follower, click to follow. Then click to retweet this show. you'll see the pinned tweet. So you go on to Boom's Bust Show biography, then see the pinned tweet. It's right at the top of the page there. You can't miss it. Scroll down. Click to retweet that particular tweet. Click to follow Boom's Bust Show. Scroll down. See the charts. Star rate on iTunes. Click on iTunes. You see UK consumer confidence has been falling since about 2014. Well, it seems to me it's actually bottomed out as it happens. Basically, this was a tweet storm by someone who wanted to put the fear of death into us all. It's rather funny because the services and manufacturing stats, purchasing manager indices, they're rising strongly. The stock market is doing really well. The next chart is the market Eurozone composite services and manufacturing PMIs. France, 59.6, above 50 in expansion. Germany, 59. Italy, 59. Ireland, 59. Spain, 56.7. These are very big numbers. Eurozone corporate, 58. Big number. Look at the next chart. What an amazing recovery by Europe. Look at Germany. Where's Germany? No, look at the whole of the EU on the right-hand side. The 2008 to 2012 average real GDP growth was basically minus. Just minus. But in the last 4 quarters, you're looking at 2.5%. That's a big change from the average for that particular 5 years, 2008 to 2012. Ireland's going absolutely crazy. Where's Germany? Oh, there's Germany. Average was 0.7%. Now, last year, 2.3%. The UK, the average was 0. Now, 1.8%. And look at our lovely company that certainly on this side of the microphone, we're heavily invested in, Greece, on the left-hand side. Average fall in GDP, 5% per annum. The last year, GDP growth, real growth, 0.6%. It's not about the size of the growth in investing terms. It's the rate of change from where you were. If you go from extremely bad to merely bad in investment terms, that's a beautiful thing. And there is indeed the Greek manufacturing PMIs. It's absolutely exploding. The headline PMI is the highest since October 2007. Employment growth, joint sharpest on record. Business confidence, strongest since the series began. Are you not invested in Greece? What the hell are you doing? I've been talking about it for the last year. The next one. You know, you think the West is fantastic or, better than the East, better than the Middle East. Average GDP growth over the last 20 years. Qatar, 10%. China, 9%. Ethiopia, India, Nigeria, Turkey, Egypt, Indonesia, South Korea, 4% or above annual average GDP growth, for goodness sake. 20 years. US, 2.3%. UK, 2%. France, 1.5%. Germany, 1.4%. Italy, 0.5%. And that's with massive levels of extra debt. Where are you invested? In developed markets or in emerging markets? Now, the next chart is so huge, it's off the scale huge in terms of importance. It's from the Federal Reserve Economics Department, and it shows US Treasuries held by the Federal Reserve and the increase or decrease. In early 2015, the Federal Reserve was increasing its treasury holdings. It was borrowing, in other words, at the rate of $240 billion a year. Through 2016 and 2017, it borrowed zero. And since the December of last year, it's only 2 months, the net borrowing has been negative. Quantitative tightening. On the left-hand side of the chart is quantitative easing, QE. We now have QT. Now, it's tiny so far compared to the QE. You know, it went from about 1,000 billion in 2007 to 4,000 billion on the balance sheet by 2015. So, you know, to fall by 30 billion is practically a drop in the ocean. 30 billion out of 4,000 billion. We get that. But what it's not is QE. And apparently, there's going to be more QT. And I've shown you time and time again how negative real rates are causing such economic growth, such inflation in the Eurozone. For how long can Mario Draghi continue having negative interest rates and doing massive QE? How long? You want to know why the euro has been soaring? So, talking of inflation, on Friday the 2nd of February, we got the earnings reports in the US. 2.9% year-on-year rate of change in hourly earnings. Thus, look what we've got. Put the puzzle all together. I've been going through it with you for months. We've got long-term interest rates, in other words, government borrowing rates, rising fast. They bottomed out in the summer of 16. 10-year rates are now 2.8%. They were 1.5%. In the UK, they were 0.5%. They're now 1.5%. Huge increase in government borrowing rates. Job numbers are up. Wages are up. Velocity of money is up. We have inflation, folks. The bond markets have been selling off right, left and centre. They've been buying index-linked government bonds. Cough, cough. We know some other people who've been doing that as well. This is inflation, folks, and it looks as if it's embedding. I hope you're invested for inflation. And just to show you what this will do to investment portfolios, to pension funds, whether it's large-scale final salary schemes that I've just been talking about or your private pension. Look at that chart of years of yield needed to recoup 50 basis points back up in yield. What on earth does that mean? If government borrowing rates rise by 50 basis points, which in other words is 0.5%. On 10-year borrowing, the US is in the middle there in orange. It'll take 2 years for investors in government bonds to get their money back. If you're, however, an investor in Germany, where you're on extremely low, if not zero or even negative 10-year rates, if the rate in Germany goes up 0.5% only, it's going to be 11 years to get your money back. Similarly, Netherlands, Belgium, Austria, Finland, Sweden, France, all 6 years and above. just for a 0.5% rise. Even in little plucky UK, if rates rise a further 0.5%, it'll be 4 years before you get your money back if you're a new investor in government bonds. On the other scale, the other sides of the scale, you got Brazil and South Africa, where it's only a few months because their interest rates are already very high. So an extra 0.5% doesn't make much difference. In other words, the interest rates in much of Europe are tiny, and probably they're going to go higher. Now, at the household scale, this is, I'm talking big macroeconomics, but what does it actually mean to real people? Well, in Britain, what we tend to do is, if you got a mortgage, you tend to fix it for 2 years or 5 years. Small numbers of people fix for 10 or 20 years. Do you know what? I can't help thinking that was a really good idea to do so in the last couple of years. I don't know what the rates are just now. It's not something that I'm involved with, so I don't know. But I wonder if a 10-year rate is not much higher than a 5-year rate, I would certainly use a 10-year rate myself, because interest rates could go through the roof over the next 10 years. But once your fix ends, and particularly if it's only a 2 or a 3 year fix, it's going to end pretty sharpish. You got to refix again. And if rates have risen, you're going to have a big increase on your monthly expenditure. Because if you were paying, let's say, 3%, and you're now paying 4%, doesn't sound a lot, but obviously it's a 33% rise in your mortgage cost. That's a big increase in your monthly expenditure. Now in America, they do it differently. You get a 30-year fix and it stays with you unless you remortgage. And of course you would remortgage if rates fell and you were paying 5% and all of a sudden 30-year fixes are available at 4%, well, you can reduce your monthly outgoing by 20%. And of course, that's what kept the American economy alive, because long-term rates have been really, really low. So people were refixing again and again at lower and lower rates. So they went out splurging on holidays and cars and gizmos and etc. and eating out and, all the peripheries of life. But look at this next chart of the US 30-year mortgage rate. As I said, rates bottomed out in the summer of 16. You could get a 30-year rate for 3.3%. As recently as last summer, you could get a 30-year mortgage for 3.7%. Now, it's 4.3%, which means that in the space of about a year and a half, the rate has gone from 3.3 to 4.3, that's practically a 30% increase in mortgage costs. Now, of course, it won't affect existing mortgage holders, but anyone wanting to buy a property taking out a new mortgage, they will have to pay the new rate. Tell me how a 30% rise in mortgage costs is a tailwind to house prices. Isn't this exactly what I've been talking about for the last year? That if we are in an era of rising interest rates, that this can only be a headwind to house prices? Obviously. Now, before I go into markets, I want to point out that Deutsche Bank is Germany. Which reminds me, I think it was September of 16, I'm pretty sure. Go onto my website, go onto the media page and go down to September and see me, listen to me being interviewed by that Marxist anti-Zionist. He pretends he's not an anti-Semite. Cough, cough. He's so much not an anti-Semite, he will not even be in the same room, I believe, as an Israeli stroke Jew. So I understand. Or debate, should I say, whatever. I mean, it's unbelievable. George Galloway is who I'm talking about. The guy sounds so reasonable with his voice and his tone. Listen to actually what he says. He's a raving Marxist lunatic. But it was a really good discussion I had with him. And I explained to him that BMW, Siemens, Mercedes, VW, Audi, SAP, they are not what they would believe, what everyone believes is Germany. Deutsche Bank is Germany. It has tentacles in everything. It's not just by far the biggest enterprise in Germany. I mean, the size of the Deutsche Bank balance sheet is 10 times the size of the German economy. It's by far the biggest bank on the European continent. And in 2015, Deutsche Bank made losses of 6.8 billion euros. In 2016, it lost 1.4 billion euros. Last year, it lost €500 million. And you're thinking, oh, well, the losses are getting smaller. That's a good thing, isn't it? At the peak, 9 years after the beginning of the so-called recovery, it's still making losses, and you think that's okay? By the way, in each of those years, do you think the bankers themselves made losses? No. Last year, Deutsche Bank's bankers earned €1 billion in bonuses, not counting their salaries, of course. This is what happens when the banks control the world, as they do. Now, the markets, there was, I'll bet you've been on Twitter, you've been on Zero Hedge, you've been reading about Peter Schiff and who would it be? Mick Shedlock, Mish, who else? That bloke, Armstrong, all the rest of it. I bet they've been saying, well, clearly it's the top. Clearly we're crashing because the markets went down a few percent last week. We'll come back to that in a moment. But this is what I want you to focus on. A really, really important chart. This is a 20-year chart of the US dollar, the basket of currencies. So against the euro, sterling, the Canadian dollar, strangely the Swedish krona, the Japanese yen. And what does it show? It shows over the last few years the widening horn pattern, showing higher highs, lower lows, and the megaphone. And clearly it started to bounce at major support. And the world and his dog is saying, well, clearly it's going to go back up to the top of the horn, the megaphone. It's going to go back up to 106, 107. That is going to crash commodities. Well, didn't I just go through with you how we've actually got inflation and how the bond market is calling it right, left, right and centre? Well, all it needs to do, in fact, is go up to the horizontal resistance, which is only slightly above, at 92. And it seems to me it fell through that hugely important support at the end of last year. It could retest it, but it seems to me that we have the breakdown and the breakdown below 92, huge support. It was support in 2003. It was support in 2014, 2015, 2016. It was resistance. It went back up to retest in 2004, 2006. And then it broke through in 2015. And it's broke back down again. That's how I read it. And of course, we've also got a rising support coming up from the 2011 low. It seems to me that they are all going to be broken. The dollar is toast. And within a few years, it's going to take out the 2008 all-time low. All-time low stretching back to Bretton Woods and the 1970s. That's what it seems to me is going to happen here. Now, of course, we need to break down out of this megaphone. Well, give it a couple of weeks. The next couple of photos are so funny. Oh, you cryptomaniacs, you crypto bugs out there, you're into your Bitcoins and Ethereums and your Ripples and your whatnots, your blockchains. Well, you know, crypto has been absolutely, utterly crashing, collapsing since the middle of December. And at the peak in December, the mainstream media, CNBC, MSNBC, CNN, my God, they were pushing crypto like crazy. And as you see, the first photo there, they showed what I call a red braces looking kind of guy. He must be clever. He's wearing a tie. He must be a really clever guy. And at the peak, they put on a crypto class, how can you buy Ripple? It was at a price of $2.57 at the point. Well, the same guy came on the show at the end of last week at 0.71 and he put on a new class. How to sell Ripple. So funny. And it's always the way. Whether it's The Economist, Forbes, Barron's, the Financial Times, the Money Pages and Money Mail, the Telegraph, Money Week, you name it, the Daily Reckonings. A lot of you sign up to these things. They tell you the world's going to crash. They tell you to buy at the peak. They tell you to sell at the trough. Do what Wall Street and the city does. Buy at the bottom and sell at the peak. Not saying buy exactly at the bottom. And who cares if it falls another 20, 30, 50% if you're buying at 10 or 20 pence in the pound. And then sell at 80, 90 pence in the pound. Who cares if it goes down initially? Buy low, sell high. There was a major Bitcoin conference called the Upfront Summit 2018. There's a great photo, the bull case for Bitcoin, and you see the three guys, the Bitcoin experts, the cryptocurrency experts in the panel. One of them's being directly interviewed by the moderator. What are the other two doing? Look at the photo. They're on their mobiles, killing themselves looking at the price of Bitcoin. That is one of the funniest things I've seen in a long time. Oh my God, so funny. Okay, all right, put it all into perspective. Bitcoin has had many major crashes, and there is a chart of them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 crashes of at least 30% until the current one. And the current one, at the last point I looked, in fact, that was based on $8,100. If I go to the chart right now, I will tell you what the price is right now. It could be higher or lower. I have no idea. The time is 3 o'clock on the dot on Monday the 5th. And the price of Bitcoin as we speak is, my goodness me, $7,325. So based on 8,100, it was a 59% fall. It must be approximately 65% fall. And actually, that's not the worst fall that Bitcoin's experienced. It's experienced an 83% fall when it went from $259 to $45, and an 87% fall when it went from $1,163 to $152, and that was from November 13 to January 15. So it seems to me pretty likely we're going to get another 80+% fall. And by the way, did I not say to you, listener, I might get interested if I saw an 80 or 90% fall? To be considered. The pound. I've talked about it a lot. I've been very bullish, the pound. I've been bullish, in fact, to my clients since late 2016. And I've been right to be so. I can tell you that the pound against the euro is currently at about the dollar is approximately 140. It's headed for 150, which incidentally is the pre-Brexit referendum value, although that in itself was probably an inappropriate price because there was suddenly, just before Brexit, there was a lurch up. I don't know why. It went from 140 to 150 in the matter of 2 or 3 months. No particular reason. It was in a general downtrend. However, it's heading back up to 150. I truly wonder, if I look at that chart, which is next, and I see how flat it was, hovering between 140 and sort of 160 for several years, with 140 actually being the base, I wonder if the breakdown over the last year and a half was a major failed breakdown. I think it might have been, you know. And if it was, then that lends credibility to the thesis that the dollar is heading down for years. The pound, the euro, the yen could be heading up against the dollar for years. Hugely inflationary, absolutely sensational for commodities, and the shiny yellow thing. So yeah, stocks are now down 3 to 5%. Gold went down $15. Shock horror probe. It's the end of the world. All the gold bears came out. All the rest of it. Well, that's funny because I look at silver, which is up 1.5% on the day. I look at I look at gold, and it's okay. It's been up. It's up 0.2%. Yeah, we don't know what's happening, but I see no change to my thesis that gold's heading for the high 1300s, 1390 or so. Silver and miners will do similarly. That's what I'm seeing, but we shall see. Very fascinating numbers. You know, the bottom of the stock market in March 09, the S&P 500 got to 666. That was the index. Now, anyone who knows anything about Christianity and the New Testament, or is it the Old Testament? I don't really know. But 666 is the sign of the devil. And on Friday, the Dow Jones went down 666 points. And the S&P cumulative December and January return, so this is from close of play on the 31st of December to the close on Friday there. Do you know what the positive return is? 6.66%. Da, da, da. If I've got time, I'm going to play you a fantastic piece from Ricky Gervais with that idiot socialist Democrat lefty Stephen Colbert. It's just brilliant, and Gervais just rips them apart. Science versus God nonsense. You're worried about the stock market? You're worried about commodities? Don't be. Look at the next chart. Financial conditions, according to Goldman Sachs, are as easy as they have been in 28 years. No worries, mate. Now, you know I've talked about uranium miners. This is beautiful. The Chief Executive Officer of Fission Uranium, one of the top efficient and quality uranium mining companies. Small company, but my God. Dev Randhawa, he's been through it all. And he made, in the prior cycle, he made investors 10,000%. So he's just gone and bought another 50,000 shares in Fission Uranium. And you think, well, that's insider deal. No, it's not. Directors and chief executives can buy shares in their own company. He now owns 4.5 million shares in Fission Uranium, ticker FCU. Now, am I pushing this company? I'm not pushing anything. I'm telling you what's happening. You have to ask yourself, why would the chief executive of a company buy more shares to become the largest single investor in the company if he thought the company was crap? And incidentally, to give you a feel for what we're talking about here, Fission trades at about 70 pence a share. So that's give or take £3.5 million. That's what he's got invested in Fission Uranium. I'm telling you, that guy, I've seen interviews. He's a quality bloke. He's about 60, 65. In 5 or 10 years when he retires, he will retire, I am sure, on £35 million. Now, instead of quotes of the week, I'm actually going to play Ricky Gervais. All I'm going to say is, I've had a blast. I'll see you next week. Thank you very much for listening. Twitter account, Booms Bus Show. Follow me, retweet. Looking forward to talking to you again next week.